What's up everyone, welcome back to another video with the Millennial Finance. For the first time since I started investing in Wahid Invest over a year ago, they're actually making some changes to their portfolios. We've had two consecutive ones in recent months, with one of them being the US only portfolio and the second one being the introduction of Chinese stocks. Ever since then, of course, we've had a lot of questions on both of this. What do we think? Is it a good thing or not? So I think that it's about time that we're going to go through some of our thoughts on these two changes. By the way, if you want to sign up for Wahid Invest and you want to support the channel, then sign up with our code, which I'll leave down in the description below. Once you invest, I think you'll get maybe 10 ringgit in a referral bonus. Anyway, let's get started with the US only portfolio. In my previous video where I talked about how I was wrong about Wahid Invest, I did go through briefly about the HLAL ETF, but I'm just going to go through it again one more time just to see if there are any changes to the composition. First of all, let's take a look at the year-to-date performance in 2021. The HLAL ETF is up around 18% year-to-date versus the S&P 500, which is up around 22%. So versus the S&P 500, it is not doing as well, but it's still doing pretty well, and I'm happy with it, especially considering that it only invests in Sharia compliant stocks. Performance is just one part though. You can get lucky, right? You could have bought one of those crypto punks at $500 and then sold it for $1 million, but it doesn't mean that it's going to continue outperforming for the long run. So what do we have to look at is basically the composition or what stocks this particular ETF holds. As I mentioned before, you can actually get a list of every single holding in this HLAL ETF on the Wahid Invest website itself, and I've done that, and I've made a neat little pie chart showing the composition of the top 10 stocks in this ETF. Surprisingly, Apple is still their largest holding at over 16%. It's not surprising to me that Apple is the biggest holding, of course. It is the largest company in the world at a valuation of over $2 trillion, but having a 16% allocation in an ETF is not normal. I remember having this comment previously as well, and it seems like they haven't changed it at all. Of course, Apple is a really good company. iPhone sales has been through the roof, services revenue has been really good, and they can continue growing their revenue as time goes on. It's just slightly uncommon for ETFs to have such a large holding in just one stock. If they really wanted to though, I would say Apple is one of those best stocks to do it. I wouldn't really feel comfortable if they put 16% in a company like, let's say, Sea Limited, Roku. I mean, these are great companies, but they're not as established and stable as Apple. Their next largest holding in this ETF is Tesla at 4%. This means that the difference between the number 1 position and number 2 position is 4 times. Their Apple position is 4 times larger than their Tesla position. They must have some crazy conviction in Apple, or maybe their fund managers just forgot to press the rebalance button, but even if you follow a valuation-based approach to weightage, Apple is not 4 times larger than Tesla. So I've just done some Googling just in case I was wrong and you guys are going to meme me. But yeah, Apple is not 4 times larger than Tesla. Surprisingly, it's actually between 3 to 3.5 times larger than Tesla, so maybe they do use this approach. Anyway, the other stocks in this ETF are also very good, and it's diverse across many industries. They have healthcare and Johnson & Johnson, they have other software companies like Adobe and Salesforce, and they have a bit of oil and gas and ExxonMobil. So to me, this ETF sort of replicates the S&P 500 more than it does the Nasdaq 100, with not too much concentration in just technology. This means that if tech continues running, this ETF will probably lose out a bit, but it's always good to have a nice diversified portfolio, especially if you're a new investor or if Wahid is your only investment. So overall, I'd say that this ETF is pretty good in terms of the stock they select, but I'm still curious as to how they select the stocks other than Sharia compliance, and more importantly, how they decide on asset allocation. Having said all of this, I have made my decision early on that I will not be switching to the US only portfolio. It's not that I don't like the HLAL ETF. Like I said, it is pretty good, especially for investors who want Sharia compliant stocks only. The main reason for this is that I like the exposure of the Malaysian market that comes with a normal portfolio, and it's something that I don't really have much exposure to in my overall investment portfolio. When looking at my entire investment portfolio allocation, I have most of my money in US stocks, so I don't need to go all in through Wahid as well. Finally, I also want some exposure to this new Chinese ETF, which is the next section that I'm going to be talking about. So this new ETF is actually a mouthful. I'm going to have to read this. It's called VPDJ Sharia China A-Shares 100 ETF. It's a new ETF that was just launched by Value Partners in the beginning of July 2021. According to the co-founder, this is the first ETF in the world that focuses on Chinese companies that are Sharia compliant. And this ETF has a benchmark which is the DJIM China A-Shares 100 Index, which is of course another Sharia compliant index. So all of this is pretty cool. Big thumbs up to Wahid. They found another opportunity within the Sharia compliant segment to sort of diversify their holdings to other regions in the world. A cool thing about this ETF is that it's actually listed on the Bursa exchange, meaning you can use local brokers like Rakuten to buy it directly yourself. This is contrary to the HLAL ETF. That one's listed on the Nasdaq, I believe, so you can't buy it with local brokers. You have to use an international broker to buy that. If you want to sign up with Rakuten and buy more of this ETF, then you can use our link, which we'll leave down in the description below. Anyway, let's take a look at what this ETF holds. Industry-wise, the largest holdings are in consumer discretionary and healthcare, followed by industrials and technology. I'm quite surprised by this because I would assume that tech would be their largest holding, similar to StashAway's KWEB ETF. KWEB is a tech ETF, which is why all of their holdings are in the technology space, but most ETFs these days actually have a very high exposure to this sector. I guess it's good diversification anyway. For those of us who also have StashAway and are invested in KWEB, there's sort of no point if both of our investments replicate each other. So yeah, another good point for Wahid. So I just took a look at their holdings and it's becoming a bit clearer to me now. So it seems like they only invest in companies that are listed in the Chinese market itself, which excludes companies like Tencent, Alibaba and JD.com, which are listed on the Hong Kong stock market instead. I don't know any of these companies at all other than BYD because I know that there's some sort of automobile manufacturer and they also have some exposure to the EV space. This is a good and a bad thing, I guess. On a positive note, I'm getting exposure to companies that I don't have anywhere else in my portfolio, but on a negative note, of course, I don't know these companies at all, so it's very difficult for me to know whether this ETF is actually holding good companies. I guess we'll just have to trust them. Also, since these companies aren't the ones under scrutiny by the Chinese government, their stocks haven't really seen the same decline as KWEB has, with it being relatively flat year to date versus KWEB's negative 36% decline in 2021. Still, it's underperforming the US markets that we saw earlier. The HLAL ETF itself is up 18%. This one is 0%, but it's probably due to some regulatory spillover. Even though these companies aren't directly impacted, investors maybe are a little spooked investing in the Chinese market. So, here are some of my thoughts about these changes. Looking at the composition of the very aggressive portfolio, which is the one that I selected of course, 65% of my investments is still in the HLAL ETF, with 20% being in the emerging markets, split between Malaysia and China. So this isn't too much. Even though Wahid introduced this, it seems that they still have the belief that US is going to outperform. They've just added around 10% to China just to give investors a bit more diversification, which I think is good, but I wouldn't mind if they started increasing this and decreasing the US allocation. However, I completely understand that many fund managers or sort of robo-advisors, including Wahid themselves, they wouldn't really want to bet against the US because considering that we've been doing so well since around 2019, it would be difficult to justify to investors why you're not performing the same as the general market. Like I said earlier as well, since my overall investment portfolio is already very heavily weighted towards US stocks, I won't be switching to the US only portfolio. I will maintain the very aggressive portfolio. If this was my only investment, if I only invested in Wahid, then maybe I would consider it because, US stocks only go up. Money printer go brrrr. Another thing is, it's really good to see that Wahid is finally making some developments to the portfolios. Even though a lot of us have mixed feelings with regards to StashAway's reoptimizations, at least you're doing something which lets us investors know that, hey, maybe this is why I'm paying 0.8% management fee. This is Wahid's first real big change as far as I can remember. Hopefully they keep this up. Hopefully they start providing more options, more ETFs, and give investors more diversity because as far as I know, a lot of people who invest in Wahid, they're first-time investors, they don't really have money elsewhere, so it's good to have a well-balanced, diversified portfolio, not just across industries, but also countries. Let us know down in the comments below, what do you think about the US stock portfolio and the new Chinese ETF? If you enjoyed this video, give us a big thumbs up and subscribe to our channel if you haven't already. If you want to sign up for Wahid Invest, then use our code down in the description below. It'll support the channel and you'll get 10 ringgit as well. See you guys in the next one. Peace out.